The market does not care about your hopes, your fears, or your potential. It is a neutral mechanism designed only to reflect the collective decisions of millions of participants. Jesse Livermore, the legendary speculator, understood this fundamental truth better than anyone, realizing that the greatest obstacle to success was never the market itself, but the toxic emotional baggage the speculator brought to the trade. He recognized that greed is not merely the desire for more money, but rather the emotional refusal to accept the reality of the present moment, whether that means refusing to accept a small loss or refusing to let go of a large realized gain. Livermore built his phenomenal career and fortune, lost it, and rebuilt it again, based on the principle that mechanical discipline must always supersede impulsive emotion. We are examining today the 3 specific, non-negotiable iron rules Livermore implemented to forge an impenetrable barrier against the destructive force of greed, rules that modern traders violate almost every single day. Before we dive into the profound lessons of the greatest speculator in history, please take a moment to ensure you are subscribed to the channel. We are dedicated to translating timeless financial wisdom into practical, actionable advice, helping you navigate the complex psychological landscape of trading. Leaving a quick comment, even if it is just a single word or a thought about Livermore, signals to the algorithm that this content is valuable and should reach more serious students of the market. This simple action helps us grow the community of disciplined thinkers who understand that control starts internally, not externally. We also encourage you to return to this channel whenever the market becomes challenging, when your confidence starts to waver, and when the natural human impulse toward greed begins to cloud your judgment. Livermore's philosophy held that speculation is a battle against the self, where hope and greed are the primary internal antagonists working to undermine rational action. The market offers opportunities, but it is the speculator's emotional reaction to those opportunities that determines profit or ruin. He formalized his understanding into mechanical rules designed to remove decision-making from the realm of feeling and place it firmly within the realm of mathematical necessity. These rules were not suggestions or guidelines, they were absolute non-negotiable commandments that protected his capital from the deadliest of human impulses. We begin with the most fundamental rule, the bedrock of capital preservation, which directly counters the deep-seated human greed to always be right. The first iron rule Jesse Livermore hammered into his operational methodology was this: never, under any circumstances, average a loss. This rule sounds deceptively simple, yet it is the single most violated principle in the history of retail trading, representing the ultimate failure to accept reality. Livermore defined averaging a loss as adding to a position that has moved against the entry point, effectively increasing exposure to a trade that is already demonstrating its fundamental error. If the trade immediately moves in the wrong direction, the initial premise upon which the trade was built was flawed, indicating that the market disagrees with your assessment. The only logical, disciplined response is immediate liquidation of the position, accepting the small, predefined loss as the cost of being wrong. Livermore's specific rationale centered on the concept of capital as a tool, a finite resource that must be guarded with fierce dedication. Adding to a losing position is the ultimate expression of greed, driven by the desperate desire to save face and prove the initial judgment correct, rather than preserving the tool required for future successful trades. This action is a psychological attempt to lower the average cost basis, creating a false hope that a minor recovery will allow the speculator to exit at break-even. This greedy hope transforms a manageable small loss into a potentially catastrophic one, tying up valuable capital in a dead trade. The great speculator understood that the market has no obligation to return to your entry price, and waiting for it to do so is financial suicide masquerading as patience. The modern violation of this rule is depressingly common and is often euphemistically called doubling down or averaging down. Driven by the greedy impulse to avoid the pain of realizing a mistake, the common trader continues to inject fresh capital into a failing endeavor. They look at the market movement and see not a signal of flawed analysis, but a temporary misalignment that will surely correct itself. This behavior is rooted in the ego's refusal to admit error, prioritizing the psychological satisfaction of being eventually right over the financial necessity of capital preservation. Every time a trader adds to a losing position, they are trading discipline for a gamble, replacing logic with a prayer. Livermore famously encapsulated this principle with the powerful statement, "It is the chief mistake of the speculator to be unwilling to take a small loss." He recognized that the small loss is an insurance premium paid to maintain liquidity and mental clarity, allowing the speculator to wait for a high probability setup. The truly disciplined speculator views the initial loss as necessary feedback, a confirmation that they should step away and reassess the broader market conditions. Conversely, the greedy speculator views the loss as a personal attack, prompting them to fight the market by committing more resources to the losing cause. This is the critical distinction between a professional and a gambler, rooted entirely in the capacity to accept being wrong quickly and cheaply. The refusal to take a small loss is the first and most critical point where greed hijacks the trading process, turning sound strategy into emotional reaction. It is the moment when the desire to avoid psychological pain overshadows the necessity of financial prudence. Livermore learned through bitter experience that trying to recover losses by doubling down only compounds the error, leading inevitably to deeper financial distress and emotional turmoil. The iron rule is simple. If the market proves you wrong, you must concede immediately, preserving your strength for the next better opportunity. This practice demands humility, which is the direct counter-virtue to the speculator's internal greed. The psychological trap of averaging down is that it feels proactive, offering the illusion of control when in reality, the trader is simply digging a deeper hole. They become fixated on the break-even point, ignoring the increasing risk and opportunity cost associated with the tied-up capital. Livermore insisted that capital should always be deployed where the probabilities are highest, not where the hopes are strongest. A losing position, by definition, has low probability, making the addition of capital an irrational act driven purely by egoistic greed. Modern technology has only amplified this violation, making it easier than ever to immediately add to a position with the click of a button, removing the necessary cooling-off period. The immediate availability of leverage further tempts the greedy speculator to overcommit to a trade that should have been liquidated hours or days prior. Livermore's rule stands as a timeless warning. The moment you decide to fight the market instead of accepting its verdict, you have already lost the battle against your own greed. True financial strength lies not in winning every trade, but in surviving the inevitable wrong calls with minimal damage. The second iron rule Livermore established dealt with the opposite side of the emotional coin, managing greed when the trade is winning. This rule dictates that the speculator must not try to capture the last eighth, meaning they must always be willing to leave a portion of the move on the table for the next buyer or seller. Greed, in this context, manifests as the refusal to sell a winning position until the absolute theoretical peak is reached, demanding perfection from an inherently imperfect, chaotic system. This demand for an impossible level of precision invariably leads to holding too long, allowing the natural reaction or reversal to erase substantial paper profits. Livermore's specific rationale for this discipline stemmed from his deep understanding of market momentum and reversal dynamics. Momentum carries prices far beyond what seems rational, but reversals are often swift, brutal, and completely unforgiving, leaving the slow-acting speculator paralyzed. The psychological shift occurs when a substantial paper profit turns into an emotional entitlement. The trader feels they deserve the maximum possible gain, and are therefore incapable of acting rationally when the market begins to turn. They convince themselves that the inevitable dip is merely a temporary fluctuation before the final push upward, ignoring the clear signals of exhaustion. The mechanic of greed in a winning trade is insidious because it disguises itself as prudence or patience. But it is actually the fear of missing out on the final, sweet fraction of the move. Livermore observed that the moment a profit starts shrinking, the speculator enters a state of emotional paralysis, refusing to sell because they cannot bear the thought of having had a larger profit just moments ago. This fixation on the high watermark prevents the realization of the substantial gains already achieved, turning a profitable trade into a psychological nightmare. The greed for perfection transforms into a bitter regret, often leading the trader to hold the position until the profit is entirely gone, or worse, until it becomes a loss. The modern violation of this rule is seen in traders who set unrealistic, distant profit targets or, even more dangerously, continuously move their stop losses further away on winning trades, chasing an ever higher high. This results in the phenomenon of winning losers, trades that were significantly profitable at one point but were ultimately closed out at zero, or even a small loss after the peak was missed. Livermore knew that the market never hands out profits easily. Capturing the main body of the move is the objective, and attempting to capture the extremities is pure hubristic greed. He understood that market reversals are swift and punishing, confirming that the professional speculator must be satisfied with the lion's share, not the final sliver. The discipline of the exit requires the speculator to recognize that no one ever goes broke taking a profit, even if they leave money on the table. Livermore taught that the goal is not to maximize the gain on any single transaction, but to maximize the cumulative return across a series of well-executed trades. Selling too early is a minor psychological discomfort. Holding too long is a major financial disaster. The difference between the professional and the amateur is the professional's ability to execute the exit plan mechanically, without allowing the euphoria of paper profits to dictate the decision. This rule is fundamentally about managing expectation and conquering the ego's desire for the perfect trade entry and the perfect trade exit. Livermore understood that market movements follow patterns, but those patterns always include unpredictable volatility near the turning points. By aiming only for the body of the move, he maximized his probability of successful execution and minimized the exposure to sudden profit-erasing reversals. The greedy speculator, however, sees the turning point as a personal challenge, believing they possess the unique insight necessary to time the absolute peak. The consequence of violating this second iron rule is often a complete erosion of trading confidence, as the trader remembers the huge profits they could have had, rather than the profits they did achieve. This emotional scarring leads to hesitation in future trades, creating a vicious cycle of poor decision-making. Livermore's advice forces the speculator to adopt a probabilistic mindset. Accepting a guaranteed profit now is always superior to gambling on a possible slightly larger profit later. The true measure of a speculator is not the size of their largest paper gain, but the consistency of their realized capital growth. The market provides signals of exhaustion, decreasing volume, wider swings, and failure to make new highs. But the greedy mind ignores these warnings, blinded by the potential for more profit. Livermore insisted that when the market starts to look shaky, or when the momentum visibly slows, it is time to exit, regardless of the target price. This preemptive action is the ultimate defense against the greed for perfection, ensuring that profits remain realized capital, ready for the next setup, rather than evaporating fantasies. Learning to walk away from the table while still winning is the hallmark of professional discipline. The third and perhaps most challenging of Livermore's iron rules is the patience of the observer. Trade only when the market clearly confirms the line of least resistance, which means the path of momentum, and avoid trading out of boredom or perceived necessity. This rule addresses the most pervasive modern form of greed. the greedy urge for constant engagement and immediate results, the desire to monetize every moment the market is open. Livermore understood that true profits come from waiting for the major movements, not from churning capital during periods of indecision. Livermore's specific rationale for enforced patience was based on the realization that capital conservation during sideways or consolidating markets is just as important as aggressive deployment during trends. Trading during consolidation is driven by the greedy urge to be constantly active, which only leads to unnecessary commissions, small, frustrating losses, and critical mental fatigue. The speculator who feels compelled to trade every day is driven by the assumption that money is constantly being made and they are missing out, a classic manifestation of greed and the fear of missing out. The market often spends far more time consolidating than trending, making the waiting period the most profitable activity of all. The importance of waiting cannot be overstated. Livermore viewed patience not merely as a passive virtue, but as the active counter-virtue to greed. If the market is not confirming a clear, powerful trend, the speculator must preserve capital and mental clarity, waiting for the unambiguous signal. He understood that attempting to anticipate the end of consolidation or trying to pick the absolute bottom or top is a fool's errand, an act of arrogance driven by the greedy belief in personal predictive powers. The professional speculator waits for the market to do the heavy lifting of confirming the trend before committing capital. The modern violation of this rule is rampant, characterized by chronic overtrading, excessive scalping in indecisive markets, and engagement in high-frequency trading fueled by the desire to monetize every minute of market time. This violation is often exacerbated by the gamification of trading platforms and the constant availability of financial news, creating the illusion that constant action is necessary for success. This greedy pursuit of activity ensures that capital is slowly but surely eroded by commissions and minor errors, preventing the accumulation necessary to capitalize on major profitable swings. The amateur wants to trade, the professional wants to profit, and often profit requires doing nothing at all. Livermore captured this sentiment when he confessed, "There is a time for all things, but I didn't know it." This quote emphasizes the long periods of deliberate inactivity required for successful speculation. Periods where the disciplined professional simply observes and waits for the perfect alignment of factors. The greedy trader sees inactivity as wasted time. The disciplined trader sees it as essential capital protection. The market will always provide signals. The speculator's job is not to create those signals, but to recognize and act upon them decisively when they appear, which is only a fraction of the time. This rule demands a profound level of emotional maturity, requiring the speculator to overcome the psychological discomfort of watching opportunities pass by, or the boredom of prolonged observation. The greedy mind seeks instant gratification, demanding that the market pay out immediately for the time invested in research and analysis. Livermore's approach forces a long-term perspective, emphasizing that the biggest money is made in the great swings, which may only occur a few times a year. Trading frequently in small, choppy movements is the surest path to mediocrity and eventual ruin. Furthermore, the patience of the observer protects the speculator from the emotional burnout that results from constant engagement. When a trader is constantly in the market, every minor fluctuation becomes a source of stress, leading to impulsive decisions driven by fatigue and anxiety. By reserving action only for high-probability setups, Livermore maintained the mental fortitude necessary to execute large, impactful trades without emotional interference. Greed for action is a self-defeating strategy that burns capital and mental reserves simultaneously. The market, in its essence, is designed to punish impatience and reward calculated waiting. The greedy speculator tries to force profits out of unfavorable conditions, while the disciplined speculator waits for the market to offer profits easily. This final rule is the ultimate test of self-control. demanding that the speculator prioritize quality of trade over quantity of activity. When the market is clearly trending, move decisively. When it is consolidating, sit back, conserve capital, and observe, recognizing that preservation is the highest form of profit during uncertain times. These three iron rules, the principle of the small loss, the discipline of the exit, and the patience of the observer, form a complete, self-reinforcing system designed to create a mechanical barrier against the destructive emotional cycle of greed. Rule 1 protects the speculator's capital from the loss aversion and ego-driven refusal to admit error, ensuring that mistakes remain small and manageable. Rule 2 protects realized profits from emotional entitlement and the demand for unattainable perfection, guaranteeing that paper gains are converted into hard capital. Rule 3 protects the capital from unnecessary action and the greedy urge for constant engagement, ensuring that resources are only deployed in high-probability confirmed trends. Livermore realized that while the specific instruments and market mechanisms might change over the decades, the fundamental psychology of the speculator remains tragically constant. The human impulse is always to hope when one should fear, to demand perfection when one should accept sufficiency, and to act impatiently when one should wait. Breaking these rules is not an occasional mistake. It is a daily occurrence for most traders because the rules directly contradict our deepest, most ingrained emotional biases. The market is merely the stage. The drama of speculation unfolds within the mind of the trader. The enduring challenge is that discipline is boring, while greed is exciting, offering the immediate thrill of action and the fantasy of instant riches. Livermore's lasting lesson is that speculation is not about predicting the future of the stock or commodity. It is fundamentally about controlling the self, managing the internal landscape of hope and greed, and adhering religiously to a proven mechanical system. The speculator who masters their emotions will inevitably master the markets, not through superior insight but through superior discipline. The rules are simple, but the execution demands a lifetime commitment to emotional rigor. If the profound insights of Jesse Livermore resonate with your own journey toward trading mastery, then we strongly recommend delving deeper into the source of this wisdom. The classic text, Reminiscences of a Stock Operator, is the foundation of modern trading psychology and strategy, offering an unparalleled look into the mind of the greatest speculator. Our new edition of Edwin Lefebvre's masterpiece goes beyond the original narrative, providing deep chapter-by-chapter commentary and analysis that translates Livermore's early 20th century experiences into practical, actionable lessons for today's complex markets. This book is not just history. It is a meticulously organized curriculum that turns historical anecdotes into concrete rules for managing risk, timing entries, and, crucially, escaping the emotional traps of greed and hope. Do not just read about Livermore's success. Learn how to apply his strategies to your own portfolio by picking up this essential volume today. You can find the link to the new edition with comprehensive commentary directly in the description below. Livermore's legacy is a stark reminder that success in speculation is not reserved for the smartest or the luckiest, but for those who possess the iron will to follow their own rules, especially when their emotions scream otherwise. Mastering the market begins with mastering the three enemies within: the ego that refuses the small loss, the pride that demands the perfect exit, and the impatience that requires constant action. Commitment to these three iron rules is the only path toward sustainable professional speculation.